Welcome back to the deep dive. Today we are cracking open a story that I think perfectly illustrates this huge shift happening in the digital asset world. The headline itself almost sounds like, well, an oxymoron, really. Wall Street money. The really deep pools of traditional finance is pouring over $100 million into this small corner of Web3 infrastructure.
That's right. And the company name is Zerohash. It's a crypto infrastructure startup. And yeah, they've just pulled in a staggering $104 million. But honestly, the dollar figure, while big, is almost secondary to the names who are actually writing the checks here.
Exactly. That's the key bit. This isn't just your typical crypto native VC money. We're talking about real institutional heavyweights. Think Morgan Stanley, the absolute titan of investment banking. Then you've got SoFi, that modern fintech disruptor everyone knows, and Apollo, the private equity behemoth. So the big question we need to answer for you, the listener, is this. When these huge financial gatekeepers could just be buying and holding Bitcoin or Ethereum for profit, why on earth are they spending $104 million to buy the digital equivalent of picks and shovels instead?
It's a really calculated strategic move, and I think it signals a major shift in maturity for the space. They seem to be moving away from just owning the speculative assets themselves and focusing more on controlling the underlying utility and compliance layers. The goal isn't just return on investment in the old sense. It's more like return on infrastructure control. They want to own the toll booth,
Yeah.
not just buy a ticket for the ride.
Okay, let's unpack this. Right. Before we really get into the specifics of why this deep dive into Wall Street's thinking is so critical, and frankly, why this funding round tells us so much about the long-term safety of the whole Web3 ecosystem, we need to just talk for a second about why we actually do this show.
Yeah, absolutely. We spend, countless hours digging through complex financial news, tech data, trying to synthesize it into insights that are actually accessible. And honestly, the only way we can keep bringing you these kinds of comprehensive, nuanced deep dives is really through your engagement.
So if you find value in what we do here, cutting through all the noise, getting straight to the core signal, please just take a moment right now. Engaging with this deep dive, liking it, subscribing, commenting below, hitting that notification bell, all of that stuff is absolutely crucial. It really is. That support helps boost our visibility, in the algorithm, and it ensures we can keep making quality, in-depth content that focuses on the future of tech and finance. We can't do it without you.
We genuinely appreciate that support, so thank you. Now let's get back to the mission for today. Our goal here is to dissect this $104 million fundraise for Zerohash and figure out exactly what it signals about the long-term safety, the maturity, and the direction of the Web3 ecosystem. It's really about shifting the conversation firmly from just volatile speculative tokens to the foundational, more durable infrastructure underneath.
Okay, let's start with those headline numbers again. $104 million for Zerohash. And like you said, this isn't seed funding. This is serious late-stage capital coming in. But crucially, it's where this capital is going that makes the story. It's earmarked specifically for crypto infrastructure, which I guess we can basically describe as the secure, compliant, back-office plumbing needed to make it all work, right?
Exactly. And that figure, $104 million, especially coming now, in 2025, tells us a lot about the market's current mood, its appetite.
Yeah.
It really signals that this specific sector, the infrastructure side, has finally matured enough to actually command significant late-stage funding. That's a really noticeable shift from, say, the kind of generalized, often pretty indiscriminate, hype-driven VC funding we saw back in 2021.
Oh, yeah, I remember that money was chasing pretty much anything with blockchain in the name.
Right. Back then, capital chased almost any idea. Today, the money seems much more selective. It's focused on, proven business models that are centered on compliance and real utility.
And that selectivity is proven, I think, by the names involved here. Morgan Stanley, SoFi, Apollo. Like we said, these aren't peripheral players. They're the established institutional gatekeepers.
Yeah.
Let's maybe dissect the strategic significance of each one, starting with Morgan Stanley. An investment bank of that size doesn't move lightly. What does their involvement specifically signal?
Morgan Stanley's participation is probably the highest level of validation you could get. It demonstrates real operational confidence. Confidence that crypto technology is moving beyond just the trading floor stuff and actually getting into core traditional finance, portfolio management, processing systems, this serious back-end stuff. Just think about what a global investment bank like that actually needs to service its big institutional clients who want exposure to digital assets.
Right, they need guarantees.
Totally. They need guaranteed segregated custody. They need low latency trading APIs. And maybe most importantly, they need complex, multi-jurisdictional regulatory reporting capabilities. It's a nightmare otherwise.
And those regulatory capabilities are completely non-negotiable, right?
Yeah.
Especially in places like Europe with MiFID II requirements or just globally with basic KYC/ML mandates. You can't skip that.
Precisely. So for Morgan Stanley, the choice is basically either spend hundreds of millions, maybe billions in years trying to build their own proprietary compliance and settlement APIs internally, which is slow, it's risky, it's incredibly expensive, or they can invest in and partner with a firm like Zerohash that already specializes in compliant infrastructure as a service, like a SaaS model.
So it's a build versus buy decision, essentially.
Exactly. And investing in Zerohash shows they view the technology as permanent. They're building the on-ramps they need to service massive amounts of institutional wealth. It validates the tech at the highest levels of banking. It says, this is here to stay, and we need the tools.
Okay, so if that's the case for Morgan Stanley, what about SoFi? What does their backing imply? Because they're already, a modern, tech-forward fintech. They already offer crypto trading to retail users. Why do they need to invest in infrastructure?
Right, so SoFi's investment is a bit different. I think it's about solidifying their supply chain and really preparing for institutional scale. They're obviously familiar with the retail exposure side, but as they grow, they need resilience. They need the system to just work reliably. So their investment in Zerohash shows they're deepening their institutional crypto footprint. It means they want to move beyond just offering simple trading. They want to start controlling the underlying tech and the compliance layers that make sure those retail offerings and any future institutional ones are stable, secure, and scalable.
So less being a reseller, more owning the pipes.
Kind of, yeah. It's a shift from being just a reseller of crypto products to securing and maybe potentially owning down the line the back-end rails that actually power them.
Yeah.
They need reliable, audited systems to maintain their public standing and customer trust. You can't have outages or compliance issues at their scale.
Okay, that makes sense. And then there's Apollo, which brings in a completely different element, private equity. Apollo deals in massive long-term capital commitments. They usually focus on cash flowing assets, utility plays, stuff that just works and makes money reliably.
Apollo's backing is absolutely key because it links crypto directly to the world of alternative investments. It signals a really long-term utility outlook. Private equity models are built on finding fundamentally sound businesses that generate predictable, stable cash flows, often over decades, not just next quarter.
The toll booth businesses.
Exactly. They love toll booth businesses. Their presence here signals they view Zerohash not as some volatile tech platform that might disappear next year, but as a utility provider, a company that can charge steady, recurring fees like basis points on transactions for essential services like trade settlement, custody, regulatory reporting. And critically, they can charge those fees regardless of whether the price of Bitcoin is up or down next week, as long as people are using the system.
Okay, so putting those three names together, Morgan Stanley, focused on compliance and servicing big portfolios, SoFi, focused on scale, reliability for retail and maybe institutional, and Apollo, the private equity giant focused on predictable, long-term utility. The core signal seems pretty undeniable. Wall Street isn't just interested in crypto anymore. They're strategically investing in the infrastructure side. It feels like they're confirming their belief in the longevity of the underlying technology itself, maybe more than the volatility of any specific token.
Absolutely. And if you connect the Zerohash deal to the broader picture of venture capital flows right now, the shift is really stark. The money is, let's say, wiser now. It's demanding clear paths to actual revenue, demonstrable regulatory compliance. It validates this very selective resurgence we're seeing in late-stage funding, but only for platforms that can genuinely bridge the gap between legacy finance and these new decentralized rails. It's targeted.
Right. Let's drill down now on this central concept, picks and shovels. We need to define exactly what that analogy means in the context of Web3. And specifically, what is it that Zerohash provides that's so appealing to these huge institutions like Morgan Stanley and Apollo?
Yeah, as we touched on, the analogy comes straight from the gold rush, right? The real lasting fortunes weren't always made by the guys digging for gold. Often, it was the businesses supplying the miners with the picks, the shovels, the jeans, whatever they needed.
For enablers.
Exactly. So in the digital world, these picks and shovels companies, like Zerohash, are essentially building the necessary rails, the digital middleware. They're creating the secure, compliant, high-throughput financial plumbing that the whole system needs to run on.
Okay, so what does that plumbing actually look like functionally? When we say infrastructure, we're talking about more than just like a fancy website, right? This is deep tech.
Oh, absolutely. We are talking about highly specialized back-office SaaS software as a service and API solutions. These are tools for other businesses. For instance, Zerohash probably offers something like a unified API. This lets an institution, say Morgan Stanley, connect to multiple different digital asset exchanges all at once so they can get the best execution price for their clients. But even more critically, they offer the compliant custody solutions. How do you hold these assets safely? They provide the trade settlement engines, how do trades actually clear? And they offer that crucial transaction monitoring layer needed for all the regulatory reporting. You have to track everything.
Right.
So this allows, for example, a Morgan Stanley client to trade crypto while Morgan Stanley itself maintains the necessary audit trail and, keeps the regulators happy. Peace of mind.
Okay, this moves us right into that discussion of safety versus speculation. Because if institutions are deliberately bypassing direct token investment to buy the infrastructure instead, this model must seem inherently safer for their massive pools of capital. Why is this model potentially safer, maybe even for an individual listener thinking about where to put their money?
Well, the safety really comes down to the revenue model. How do they make money? Infrastructure firms like Zerohash profit from volume and activity, not necessarily from the price of the assets going up. They generally operate on a fee-based utility structure. Often it's basis point fees, tiny percentages charged on transaction volume or settlement actions or assets under custody.
Okay.
So as long as the entire Web3 ecosystem continues to grow, meaning more transactions, more institutional participation, the infrastructure firm makes reliable, predictable revenue. They are, in theory, somewhat indifferent if Bitcoin is $100,000 or $10,000 next month, as long as transactions are still happening on their rails.
Let's pause there for a second. Can you elaborate on how that differs, fundamentally, from the speculative model of just buying coins?
Sure. The speculative model, just buying tokens like Bitcoin or Ether, relies entirely on the highly volatile, often sentiment-driven appreciation of that specific asset's price. The value is tied almost completely to market psychology, future hopes, network effects. It's hard to pin down sometimes.
Yeah, very unpredictable.
Right. An infrastructure play, by contrast, is more like a bet on the utility function of the entire ecosystem. It's inherently a less volatile, clearer business model, because the revenue stream is ideally more predictable and tied to the consumption of a service, not just wild market swings. This is closer to the definition of stable, institutional-grade revenue that companies like Apollo look for.
And this recognition, then, that crypto provides maybe a superior settlement layer or a new way to handle assets, that seems central to this financial plumbing argument you mentioned. It sounds like crypto is transitioning from being seen only as a volatile asset class like digital gold to being recognized as an essential financial utility, a new layer for things like global payments, custody, maybe faster, cheaper settlement.
That is, I think, the pivotal shift that's driving this kind of investment. Traditional finance, the big banks, they can't just adopt raw blockchain technology easily. It doesn't just plug into their ancient mainframes.
No kidding.
They need compliant middleware. They need translators, essentially. They aren't going to build an entire custody or reporting solution from scratch for every new asset type. It's too complex, too slow.
Yeah.
So they will partner with a compliant VC-backed firm like Zerohash that specializes in that specific security piece, that regulatory integration aspect, because honestly, it saves them enormous amounts of time, money, and probably most importantly, regulatory risk and headache.
And this directly fuels mainstream adoption, doesn't it? When a bank uses Zerohash behind the scenes to settle a trade involving a tokenized asset, or when SoFi uses their APIs to manage customer crypto balances in a compliant way, it expands the actual usage far beyond just the crypto-native communities.
Exactly.
We're talking about pushing usage into, structured financial products, maybe treasury management for companies, maybe even high-volume cross-border payments eventually.
That's the key metric, I think. The true measure of mainstream adoption isn't just how many people own a particular token. It's how deeply the underlying technology gets integrated into foundational global financial products and processes. Infrastructure like Zerohash facilitates the smooth, compliant movement of these digital assets, which is the absolute necessary prerequisite for any major financial player to even consider participating at scale. We're literally watching the integration happen now, but it's happening at the operational level behind the curtain. And that's far more profound in the long run than just retail trading hype.
Okay, so the involvement of these big traditional finance firms like Morgan Stanley, Apollo, it seems intrinsically linked to the whole regulatory landscape. I mean, when firms like these commit nine-figure sums, over $100 million, they're not just sitting back and passively hoping for regulatory clarity someday, are they? It feels like they're actively investing in platforms that basically enforce clarity from day one.
That's a really key distinction, yes. Institutional backing like this actively accelerates regulatory clarity, or at least the adoption of best practices. These firms demand compliance-first operations from any partner they work with, especially with this amount of money involved, which often means that a company like Zerohash has probably already built its platform to adhere to the strictest potential global regulatory standards that maybe haven't even been fully codified yet for all digital assets they have to anticipate.
So they're building for the future regulator.
In a way, yes. They're essentially saying, through their investment, we will invest heavily, we'll put our name behind this, but only if you provide the robust governance, the auditability, the reporting framework that keeps us safe and compliant.
So it's the market leaders themselves setting the compliance standard, effectively de-risking the whole sector for everyone else who follows.
Exactly. This kind of investment acts like a powerful gravitational force. It pulls the entire sector towards more mature, institutional-grade operational standards. The investment itself is almost certainly contingent on things like strong internal controls, proper balance sheet management, segregated customer funds, all the basic hallmarks of traditional finance governance that were sometimes missing before.
And we learned why that strong governance is absolutely non-negotiable through some really painful, very public failures, didn't we? We kind of have to use the cautionary tales here, like the collapses of BlockFi and Celsius, to underscore why compliant infrastructure is so desperately needed now.
Oh, those collapses were just devastating for the industry's reputation and for the customers involved. And what they fundamentally exposed was the massive systemic risk inherent in those non-compliant, often highly speculative models that just lacked auditable, institutional-grade controls. The core issues, when you dug into them, involve things like really opaque balance sheets, the commingling of customer funds with company funds, aggressive centralized lending practices. And a lot of it was conducted outside the kind of rigorous oversight that traditional investors expect and regulators demand.
So when Wall Street looks at a company like Zerohash today, they must be seeing the absolute antithesis of those failed models.
Precisely. They are essentially investing in the fix. They're backing the solution. Zerohash, being an infrastructure firm, is expected to provide services like non-custodial or properly segregated custody solutions, automated AML KYC screening, built-in real-time transaction reporting capabilities. This is the safer, compliance-focused solution that institutional money demands now. That appetite in the market for super high-risk, opaque speculative yield, it seems to have been largely replaced by a demand for verifiable operational integrity. Show me the controls.
Okay, so if we connect this focus on integrity and compliance to actual institutional adoption metrics, what data points out there support this thesis that big money is actively building the future now, rather than just sort of waiting on the sidelines?
Well, look at the internal infrastructure requirements that institutional trading desks have. They're incredibly demanding. They need things like high-speed, very low-latency API connections directly to exchanges. They need guaranteed atomic settlement, meaning the trade either happens completely or not at all, instantly. And they need rigorous pre-trade and post-trade compliance checks built into the workflow.
Stuff that just wasn't there in the early days.
Not at all. So the growth we're seeing in specialized institutional crypto trading platforms, which demand these kinds of advanced features, confirms that big money isn't only present, but it's actively demanding tools that mirror their existing, highly regulated trading environments in stocks or bonds. They aren't going to settle for using the same retail-grade exchange interfaces you or I might use. They need industrial strength, zero-hash level APIs, and infrastructure.
That raises an interesting point, though. If these institutions are already trading, already incorporating sophisticated crypto functions, does that mean they're actually much further down the adoption path than the public often realizes?
Without a doubt. I think the public mostly sees the volatile token prices on the news, right? But behind the scenes, the operational integration is accelerating really rapidly. Consider Fidelity Digital Assets, for example. That's a huge traditional finance giant. They aren't just investing in external firms like Zerohash. They're also building their own internal custody and trading services specifically for their institutional clients.
Right, they're doing it themselves, too.
Exactly. And this internal investment further validates the entire infrastructure sector. It indicates that compliant back-office digital asset processing is now viewed as a core, permanent business component for them, not just some temporary external fad they're dabbling in. The institutions are getting serious about long-term integration and, frankly, control.
Okay, so given this enormous infusion of institutional cash, particularly from private equity like Apollo, we kind of have to look towards the eventual exit strategy, right?
Mm-hmm.
Which brings us to the IPO question. Will these compliant infrastructure companies, like Zerohash, eventually follow the path paved by others and see, blockbuster public market exits go public on the stock exchange?
Yeah, for investors like Apollo especially, the public market exit, the IPO, is often the ultimate goal. That's how private equity typically realizes those massive returns on their investment. They build it up, make it stable, then sell it to the public markets. They're definitely looking for liquidity and a big payoff on their infrastructure bet down the line. And yes, absolutely, the precedent for this path has already been firmly established in crypto.
The Coinbase IPO back in 2021 seems foundational here, doesn't it? It wasn't the IPO of some new volatile token. It was the IPO of a compliant, regulated exchange and custody provider, a pure infrastructure player, essentially.
Coinbase was absolutely pivotal. It showed Wall Street and the world that there was enormous public market appetite for crypto-adjacent equity, for stocks related to crypto. It proved you could sell the digital picks and shovels to the public, get valued in the tens of billions of dollars, and maybe most crucially, that regulators would actually allow a compliant crypto business to function as a public company.
That was a big hurdle cleared.
Huge. It fundamentally legitimized the infrastructure business model in the eyes of public market investors and regulators.
And we seem to be seeing that trend continue with other firms that prioritize utility over pure speculation, like Circle, right, the issuer of the USDC stablecoin. Their progress towards an eventual IPO seems to reinforce this idea that utility, the plumbing, is currently valued much higher by serious investors than just pure speculation.
Circle is almost the perfect definition of stable, compliant financial plumbing in the crypto world today. Issuing a regulated dollar-backed stablecoin like USDC that operates under intense regulatory scrutiny, sure, but it offers predictable, massive-scale utility. People use it constantly for settlement. And the market seems to be valuing that clarity, that predictability, and that regulatory framework very highly. It offers a clear, auditable business model that's far more appealing to institutional public market investors than, say, highly volatile crypto mining stocks or pure speculative trading platforms with unclear futures.
Okay, but going back to Fidelity Digital Assets for a moment, we have this interesting contrast. If Fidelity, a huge incumbent, is successfully building its own internal custody and trading systems, doesn't that maybe suggest a degree of distrust in external providers like Zerohash? I mean, if they can build it themselves, why would Morgan Stanley or SoFi need to invest in someone else? Why not just build in-house?
That's a really critical point to debate, actually. Fidelity's internal build definitely serves as a proof of concept. It validates the demand for secure, compliant institutional access. So that's positive for the space. However, the external investment in a firm like Zerohash by other giants signals a couple of important things, I think. First, probably speed to market. Building sophisticated proprietary financial technology takes years and huge resources. Investing in or partnering with Zerohash means Morgan Stanley can potentially integrate specialized, compliant API access far, far faster than building it all themselves.
So time is money.
Exactly.
Yeah.
And second is specialization. Zerohash presumably is laser-focused on just this one area. They can potentially handle complex multi-jurisdictional compliance, connect diverse blockchain ecosystems in a way that often exceeds what even a single large institution can efficiently build and maintain in-house, especially when it's not their primary core business. It's an investment in that deep specialization and the immediate integration capability it offers.
Okay, so maybe it's not necessarily distrust, but more a recognition that building everything internally is just inefficient, especially when you can partner with or invest in a best-in-class utility provider.
I think that's a fair way to look at it, yeah. And that brings us back around to SoFi again. Fintechs like SoFi thrive on agility, being lean, moving fast. SoFi already has significant parts of its business tied to offering crypto products to its massive retail customer base. This investment in Zerohash looks very much like securing their supply chain for the future. They're essentially ensuring that their back-end infrastructure partner is robust, compliant, and well-capitalized enough to scale reliably as SoFi's own user base and perhaps institutional aspirations continue to grow. They need that foundation to be solid.
So the long-term bet from all these different angles, investment banking, fintech, private equity, seems to be placed firmly on the pipes. On the infrastructure.
It seems that way because the pipes carry all the transactions, right?
Yeah.
Regardless of the ultimate destination or the price volatility of whatever specific asset is being moved through them, the toll booth keeps collecting tolls. Hashtag, tag, outro.
So what does this all really mean when we put it together? We started with that staggering $104 million headline for Zerohash, and I think we've kind of concluded that this is far more than just a simple funding round. It feels like it confirms a fundamental, maybe irreversible shift in market psychology around crypto. Big money, Wall Street money, now seems to view crypto not primarily as a speculative token casino anymore, but as essential financial plumbing for the future.
Yeah, the focus seems squarely on utility, on compliance, and on institutional-grade security and reliability. The investment thesis driving these big checks is seemingly no longer about chasing the absolute highest, riskiest yield possible. It's shifted towards securing the lowest operational risk. Investors are backing these compliant utility providers, the ones who service the entire industry, because they recognize this as a far safer, more predictable place to deploy massive institutional capital compared to just chasing the next market pump in some token.
Okay, this shift towards institutional control, often via owning or funding the infrastructure, raises a pretty profound final question, I think. Something for you, the listener, to maybe chew on. Will the heavy involvement of these giants like Morgan Stanley and Apollo actually accelerate the legitimization and the necessary mainstream adoption of crypto faster than any token price rise or retail frenzy ever could? Or does this consolidation of control within these compliant infrastructure layers maybe run contrary to the original sort of decentralized ethos of crypto? Is there a tension there?
That's a great question, and maybe a more personal one for listeners to consider. Given this dramatic shift in institutional focus and the potentially high valuation of these infrastructure plays, would you now maybe pivot your own strategy? Would you consider investing in crypto infrastructure stocks, things like a potential Zerohash IPO down the line? Or maybe Coinbase now seeking that potentially stabler, utility-based growth? Or would you stick with the higher risk, potentially higher reward tokens themselves, betting directly on the future value of those more volatile assets? That choice really defines whether you're betting on the ecosystem's foundation, the plumbing, or on its most speculative, potentially groundbreaking assets.
An essential distinction, definitely, and one worth pondering deeply as the space continues to mature. That's it for this deep dive. Thanks for joining us, and we'll catch you next time.